Investing can be a daunting concept for many people, but understanding the basics of stocks, bonds, and ETFs can help demystify the process and empower you to make informed investment decisions. Stocks, bonds, and ETFs are three of the most common types of investments available to individual investors, each with its own unique characteristics and potential benefits. Let's start with stocks. When you buy a stock, you are purchasing a small ownership stake in a company. This means that you are entitled to a share of the company's profits and assets, as well as voting rights on certain corporate decisions. Stocks are typically considered higher-risk investments, as their value can fluctuate significantly based on market conditions and the performance of the underlying company. However, they also have the potential for high returns, making them an attractive option for investors looking to grow their wealth over the long term. Bonds, on the other hand, are debt securities issued by governments, municipalities, or corporations. When you buy a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of your principal investment at maturity. Bonds are generally considered lower-risk investments than stocks, as they are typically less volatile and offer a fixed income stream. However, they also tend to have lower potential returns, making them a popular choice for investors seeking income and capital preservation. Finally, ETFs, or exchange-traded funds, are a type of investment fund that trades on a stock exchange like a stock. ETFs are designed to track the performance of a specific index, sector, or asset class, providing investors with diversified exposure to a wide range of securities in a single investment. ETFs are often lauded for their low costs, tax efficiency, and flexibility, making them a popular choice for investors looking to build a diversified portfolio without the need for individual stock or bond selection. When it comes to building a diversified investment portfolio, it's important to consider your financial objectives, risk tolerance, and time horizon. A well-diversified portfolio typically includes a mix of stocks, bonds, and ETFs to help spread risk and maximize potential returns. By investing in a variety of asset classes and sectors, you can reduce the impact of market volatility and increase the likelihood of achieving your long-term financial goals. There are several investment strategies you can use to build a diversified portfolio tailored to your individual needs. One common approach is asset allocation, which involves dividing your investments among different asset classes based on your risk tolerance and investment goals. For example, a conservative investor may choose to allocate a larger portion of their portfolio to bonds and cash equivalents, while a more aggressive investor may prefer to focus on stocks and ETFs for higher growth potential. Another strategy is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can help smooth out market fluctuations and reduce the impact of emotional decision-making on your investment returns. By consistently investing over time, you can take advantage of market downturns and potentially lower your average cost per share. It's also important to regularly review and rebalance your portfolio to ensure that it remains aligned with your investment objectives. As market conditions change and your financial goals evolve, you may need to adjust your asset allocation to maintain a diversified and well-balanced portfolio. By staying informed and proactive about your investments, you can maximize your chances of long-term success and financial security. In conclusion, understanding the basics of stocks, bonds, and ETFs is essential for building a successful investment portfolio. By diversifying your investments across different asset classes and sectors, you can reduce risk, increase potential returns, and achieve your financial goals over time. Whether you're a seasoned investor or just starting out, taking the time to educate yourself about investing can help you make informed decisions and secure your financial future.